So where do we see the macro going in the future? Well, the good thing is where equity valuations are at the moment, we expect to see returns that beat inflation, so positive real returns. However, when you look at the global growth picture, we do see that there is going to be slower growth than we've seen in the past. And there's a bunch of reasons for this, but really it comes down to the debt that caused the previous crisis. There was an awful lot of extra money borrowed going into the crisis, and that money needs to be repaid. And so, although a massive sticking plaster was put on, and that solved the problem for the short term, in the long term, we're going to have to sort of give that back. The easiest way to think of this is borrowing a few extra rand every month off your credit card. You have extra growth, you have extra spending power, but there comes a time when you need to start paying that back. And that means you have slightly less growth, slightly less spending power, and that's exactly how we see the financial markets. So we see the US continuing to grow, but perhaps not as fast as it has in the past as that debt begins to get paid back. We see Europe being a positive growth economy. We think the measures that the ECB have taken, very sensible. It leads to a solution in the long run, but it is going to be a slow growth region, really until a lot of adjustments happen in society, in the cultures and productivity in those countries. As we look wider afield into emerging markets, there is going to be good growth about emerging markets. People fall in love and then fall in hate with emerging markets, and sentiment swings are very dangerous. Now, what is happening is there is a big rebalancing happening. So China is having to move itself to a more consumption-based economy. This has big impacts for the shape of its economy, but also the shape of economies around the world. Obviously, that has effects in terms of what type of resources, what type of minerals it demands from around the world. Now, it doesn't mean that all minerals and all resources are out, but it means it's just going to be changing patterns. However, when you look at the core growth story in emerging markets, that emerging middle class, that is still a really attractive place to be. The difficulty can be working out how to access it. And we think the best way to access this is not to go and invest directly into these emerging markets, but it's to go and buy really high quality companies listed in typically developed markets. Companies like Unilever, 50% of its sales come from emerging markets. They have arguably the best distribution network for consumer goods in India. You can go and capture that growth, but you can do it in a really risk-adjusted way, really sensible with a management team, great brands, and this cash return that we've talked about as a really important function. So broadly speaking, yes, there's going to be growth around the world. It's going to be slower. Now, what that means is that also there's a little bit more volatility in the world. We've just got to accept that if you're driving slightly slower, you're walking slightly closer to that cliff edge where people start to worry that growth may end, you're just a bit more nervous. Things are a bit more shaky. And that's where we feel we are at the moment. And that's, again, why we think that for people to go internationally, if you want to invest there, this is a really sensible way to start. Because BlackRock's Global Equity Income Fund is not investing in risky stuff. It's only investing in the companies where we understand the business model, where they're high quality, and where they're generating enough cash to give you that reliable stream. So the macro as a whole, it's a sobering picture. It's not a bad picture. It's definitely positive. There is growth. There will continue to be growth, but perhaps not as fast as it has been in the past.